Welcome to the TAC Index AI podcast. We're the place where we blend TAC IP data, reports, and charts with the latest news and logistics, especially focusing on air cargo. Today, we're going to trace some of those ripple effects, from global instability right through our supply chains. We'll connect the dots between air freight, ocean shipping, and the wider macro market. It's really a deep dive into how logistics is doing this constant balancing act. So let's dive right in. Looking at the air cargo market first, using the latest TAC index data, global air freight rates, they dipped slightly last week. The Baltic Air Freight Index, BA-A0, was down 0.7% week over week and 6.5% year over year. But I guess those headline numbers don't really paint the whole picture, do they?
No, they really don't. That's a good point. What's actually quite insightful and easy to miss is the huge variation between regions. So, for instance, China outbound rates to the U.S., they saw small increases week over week. But year over year, we're still talking double-digit declines there.
Okay.
And then you look at somewhere like Frankfurt, a massive drop, 9.6% in just 1 week.
Wow, 9.6.
Yeah. It really shows how shippers are, having to react very quickly, adjusting supply chains almost geographically because of tariffs or trade rule changes. It's not just tweaking costs. It's like they're redrawing their maps in, well, pretty much real time.
That sounds incredibly complex, that strategic redrawing. And thinking about the carriers themselves, the thing that must always be critical is fuel cost, right? That persistent impact.
Oh, absolutely. Fuel is always a huge factor. We did see oil prices ease off a bit this week, mostly linked to higher U.S. diesel stocks, it seems. But the big challenge for air freight isn't just the price right now, it's the volatility. With the ongoing risks around Russian supply.
It's uncertainty.
Exactly. That unpredictable swing makes long-term planning, hedging, all of that. It becomes a really high-stakes game for airlines. They end up having to build in bigger risk premiums, which, squeezes their margins even more than if prices were just high but stable.
Makes sense. Okay, so the air cargo market's definitely juggling its own pressures. But everything's connected, isn't it? These shifts don't happen in a vacuum. We're seeing something maybe even more contentious happening with sea containers, especially those new U.S. port fees on Chinese ships that kick in October 14th. So are carriers just going to pass those costs straight on, or is this triggering something more fundamental?
That's a really crucial question, and I'd say it's definitely more of a strategic shift we're seeing.
Right.
These fees, they can be pretty hefty, up to, $2.7 million for a big vessel per trip?
Wow.
Yeah. It's the U.S. basically pushing back against what they see as unfair trade practices, like state subsidies giving Chinese lines an edge. And the reaction. Carriers are actively, rotating their Chinese-built ships out of the U.S. routes. So it's not just a simple surcharge. It's a direct financial hit, forcing them to use ships less efficiently, potentially disrupting global networks.
Right, so actual disruption and inefficiency, even if they haven't slapped on surcharges just yet. And this is all happening when U.S. trade flows already seem a bit, sluggish.
Exactly. Spot on. The timing is really tough. It lines up with forecasts that December imports could hit a 3-year low.
Oof.
Yeah. So it's like adding extra drag onto a supply chain that's already kind of slowing down. It's not just one extra fee to manage. It's dealing with these structural changes in ship availability and trade volumes at the same time.
It really sounds like a tangled web, doesn't it?
Yeah.
Operational hurdles, policy moves. But if we zoom out a bit, what does all this, the trade policy, the logistics jams, the cost pressures, what does it mean for the bigger macro picture? Can parts of logistics kind of shield themselves, or is it also interconnected that every tremor gets felt everywhere?
That's the million-dollar question, isn't it? And while, maybe some niche areas might be a bit insulated, generally speaking, yeah, these tremors ripple right through. If we connect it to the macro view, look, the Fed is widely expected to cut rates, maybe a quarter point. Now, normally you'd think, okay, that stimulates the economy, maybe boosts demand for goods, which is good for logistics. But this cut is happening as the job market seems to be softening, which could signal a broader slowdown that might just dampen freight volumes anyway, regardless of rates. So counteracting forces. Precisely. And then you add inflation, still a worry, projected around 3% for Q4. And these new tariffs, the inefficiencies we just talked about, they could actually push inflation up. Right. So it's a very dynamic, often quite unpredictable situation for businesses, for consumers. These trade decisions aren't just isolated policy moves. They're pulling pretty powerful levers on the whole global economic engine.
A dynamic landscape indeed. Okay, as we wrap up this deep dive, here's something to think about, maybe a provocative thought for you. Amidst all these constant shifts, trade, geopolitics, economic policy, how will global logistics keep evolving to balance that need for efficiency with the growing need for resilience? and what kind of innovative solutions, maybe even unconventional ones, might pop up to manage these complexities, especially when every policy lever seemed to send ripples far beyond where it was aimed.